Okay. I'm Dan Rosen, Chair of the Alliance of Angels, and we're very pleased to offer the next in our series of sequester workshops. This one is being given by an old and dear friend, Gary Kocher, who has been a sponsor of the Alliance of Angels for 20 years at least, I think, and is one of the best corporate attorneys in the Pacific Northwest, maybe in the country, and is very active in all forms of documents and deal sorts. If you're going to be doing an IPO, you want Gary at your table with you, and or an acquisition for that matter. But he's great at getting companies going as well, and he's part of K&L Gates, formerly Preston Gates and Ellis. Has been practicing corporate law for, what, 3 years now? 4 years? And
gotta add a zero.
I actually happen to know one secret about Gary, which he may decide to divulge during the course of this, that one of his office mates in his first job out of law school is somebody quite famous. But if you don't want to talk about that, that's good too. So with that introduction, I will turn it over to Gary to cover today's topic, safes.
Awesome. Well, thank you for that very flattering introduction, Dan. If I could only be half of the person that you described, I'd be very overwhelmed with that. But thank you. And just to touch on the person you were alluding to, when I first, actually I was a law student. This was back in 1986, a first-year law student. Really had no idea what the world was all about. And, I found myself sitting next to another law student. We both had a job at Sidley and Austin in Chicago, and the woman's name was Michelle Robinson. And she was a very, very friendly, nice law student from Harvard.
You mean she was a Princeton graduate, Gary?
Well, I think she was a Harvard law student at the time. So we got to spend the summer together and got to know each other. And then a few years later, she met her husband, who was also a summer associate a few years behind us. And they're both in the news a lot these days. But that's not what we're here to talk about. So what Ejane asked me to do was have a little bit of a talk on safes, and from time to time we've done tips of the month to give you a little bit of a background on what the terms are and what these things are, what they're intended to do and where they came from. So today, this is, I think, loosely labeled a workshop, but it's really going to be intended for you guys to ask as many questions as you want during the course of our hour here, and I'll try to give a little bit of background, but then just open it up to have some discussion around these documents that are called safes. And so for those of you who are able to see a screen, I'll see if I can share my screen here. There we go. So Dan, can you see my screen now?
I can see your screen. You should go to full screen.
Okay, let's do that.
Couple over to the right. There you go.
Perfect. Okay, so SAFEs, the reference SAFE is an acronym for Simple Agreement for Future Equity. And it was an invention in the Bay Area by an accelerator called Y Combinator, who many of you probably are familiar with, but they have launched some of the Bay Area's most successful companies, from Stripe to Airbnb to Dropbox, Instacart, DoorDash, hundreds of companies down there that have gone on to become very successful uh, companies, all started at Y Combinator. And they came up with this idea back in 2013 to simplify the concept of what had been previously covered by convertible note financings, where a company wanted to raise some money but didn't either want to set a valuation or couldn't agree on a valuation with the investors. And so it was a way to give companies some money in advance of having a priced equity round, but that would convert into equity at a later date. And then, you know, as many of you are familiar, convertible notes, you know, are still used today, and many companies that come to the Alliance of Angels are seeking to raise money using a convertible note. And that is a debt instrument. So it's you know, like any other debt obligation that the company issues. In terms of priority, debts always get paid out before any equity gets paid out. So it's more, a convertible note would be more senior than the most senior preferred stock in a company. The other feature of convertible notes is they have a maturity date and an interest rate. And so, you know, from the day that the company issues a convertible note, the clock is ticking basically, where they have, you know, set time to raise a priced equity round that would convert the notes, or they become due at the maturity date. And all the while, there's, you know, interest that's accruing on the principal. And so what Y Combinator said was, this isn't really what, you know, the investors are bargaining for in this type of situation. It's not really a debtor or creditor situation. It's really, you know, an equity investment that's just waiting to happen. And so, you know, having something like a maturity date and interest rate don't really fit, you know, the business terms here. So let's come up with a different type of instrument to document this relationship. And so that's where safes came from and how they came about. They were also intended to try to simplify things, and I think, you know, there's, I think, differences of opinion as to whether or not they really do simplify things. Convertible notes have become pretty standardized these days, and so, you know, they're not very complicated. You don't have to do a lot of negotiation when you're doing a convertible note. So, you know, the premise of simplification, to me, you know, doesn't hold that much water. But if you've looked at a safe, there's the second paragraph of the safe says basically, this is a standardized document, and the parties agree that they've made no modifications to this instrument from the standard form. And so that's actually an important thing to look for, because if that's been stripped out, that means someone's been tinkering with the safe, and it's not the standard form that you find on the Y Combinator website. And so that's the first tip-off, I think, as an investor that you want to look for, because then it'll open the door to, you know, ask questions about, you know, what sort of things have been modified from the standard thing. And so Y Combinator publishes these things on their website. If you just Google safe forms, it'll take you there. And there's basically 4 forms of safe that they put on up on the website. And they kind of match what you would think a convertible note would look like. There's a form that has a valuation cap with no discount. There's a form that has a discount but no valuation cap. There's a form that has a valuation cap and a discount. And then there's a form that's no cap, no discount, but it has a MFN provision that says, you know, if the company issues a convertible instrument that's more favorable to the investor, it will notify you, and then you have the opportunity to elect to get that subsequent instrument in the place of the one that you signed up for originally. So that's the MFN version. So, you know, as I mentioned, you know, it's not a debt. So it's, you know, a convertible note would show up as a debt on a balance sheet. So it's most likely a short-term current liability because most convertible notes have a year maturity date. But safes don't have any maturity date. And there's actually no formal obligation to repay the money. So once you, as an investor, give a company, you know, an investment and take back a safe, there's no obligation to repay that money at any point. So it's in that sense, it's like an equity investment because, you know, it's kind of like equity in waiting in the sense that you give the money to the company and then you wait for the company to either do an equity financing round that converts the safe, or if the company gets acquired before there's a round that converts the safe, then there's provisions for a payout in a sale transaction. And you know, and in that situation, you basically get the greater of either you get your money back, and in that case, it says the safe is supposed to be treated as a repayment of a loan, so it's more in a liquidation priority. It would be paid back as a debt. But the second alternative is you could convert it into equity at cap price, in which case you get factored into the liquidation waterfall as common equity. So it's an interesting way that it deals with payment if the company were to be acquired at maturity, or if the company were to be acquired before the safe converted. And it's not clear to me legally if you could be paid out as a debt, even though that's what it says in the safe. So you know, there might be some question, you know, if there were other creditors out there and it became contentious, they might argue that the safes should not be treated as a debt and it should be treated as equity. The other thing that's interesting from that perspective is your tax ramifications. Is, you know, how do you treat your capital gains holding period and holding period for Section 1202? You know, how does that all mesh with a safe? And there's some disagreement out there among accountants and tax practitioners, and you know, I know there's some. I see Matt Medlin's on the line with us, and some other accountants might also be on here. But I think the prevailing sense is safes. They're not equity until they're actually converted. So your holding period for both capital gains and for 1202 purposes would not commence until you convert into equity. So, you know, and that's not any different from a convertible note. So, you know, the safe isn't putting you in a disadvantaged position vis-a-vis the convertible note, but you're not going to be able to take advantage of those, more favorable capital gains and qualified small business stock provisions until the SAFE actually converts. So that's just something to be aware of, at the time you're making this investment. I did see there are some practitioners that said and have written that safes could be, you could start your capital gains holding period at the time you actually invest in the safe if it was intended that the safes were going to be basically converted very soon after the issuance. If it was part of a priced round that just hadn't been fully documented yet, there is some, there are some people that are saying that you can start your capital gains period earlier than the conversion, but I think that's probably a minority view, and I wouldn't, it's probably a little bit risky to take that position. The SAFE forms have evolved since 2013 when they were first introduced, and the current versions that are out there now are what are known as post-money forms. So basically what they do is they include all the safe investment in the capitalization when you're determining what the conversion price is for the safe. So basically it puts all the safes into the number of shares outstanding at the time that the note is converted. So it gives you basically a more favorable conversion rate. So it in effect, would dilute the founders more. It really comes out of the founders' pie share of the capitalization in the next price round when it converts, as opposed to putting safes and convertible notes into the cap table only after the conversion takes place. So that was kind of the biggest change when they updated these forms about a year ago. There are some other bells and whistles that go along with it, and again, sort of take away from the simplification premise. There's a pro rata rights side letter that Y Combinator publishes, and then I've seen a lot of other side letters where people get all kinds of other rights, from information rights to observer rights to MFN rights. So you can have side letters that can go on for 2 to 3 pages that kind of match the complexity that is included in the safe. So again, it's something when you're looking at these things, that'd be something to ask the company about is, have you issued any side letters, and are there MFN clauses out there? So these are things that you want to maybe have on a checklist of questions that you run through. If you think about doing a safe investment, they're not as standardized as one might think, as the companies may represent. A few other the changes that have come about. The safes now do get dividend rights, so again, it's kind of pushing you closer to that equity category. And then they also changed the amendment provision that said safes can be amended with sort of a majority consent concept, which some notes have that, some don't. You know, I think when notes and safes first came out, you know, it required each individual holders consent to make an amendment. But as time went on, the practice evolved so that the investments could be amended with the consent of a majority group. And so that's something from an investor's perspective where, you know, you want to have a good read on, you know, who can control, you know, how these things change, and, you know, because what you think you're investing in might be changed, you know, by a group, you know, and understanding who's part of that group and how they may or may not have different interests from your investment interests. You know, plays a pretty good role.
They use their district, yeah. It's like there's.
Okay, can I ask anybody asking a question identify themselves?
Yes. Yes.
I'm sorry, was that a question? I couldn't make it out. Maybe.
Are we ready for questions, Gary?
Let's see. Yeah, I think that's kind of the basics of the safe security. So yeah, why don't we open it up for some questions, and yeah, I'd be interested to hear, you know, what people, you know, if you're being presented with these opportunities and, you know, people's perspectives.
Okay, can you stop sharing your screen, please?
Yes.
We can see everybody. Great. And I'll ask that anybody asking a question identify themselves first. Make sure you take yourself off of mute and we're good to go. But if I can, as the moderator, I'll ask the first one. One of the things that's always scared me about safes is that given that there's no minimum to the round that you get raised, is there anything that stops the company from doing a very small common round, converting the safes into common, and then going to do the real equity round?
Good question. Yeah, because in a convertible note, there's usually some parameters around what constitutes a qualified financing that will trigger the conversion. And, you know, it's usually, there's a specified minimum threshold, and oftentimes it says it has to be preferred stock. But in a safe, there is no, there's really no definition around what triggers the conversion, and the company just has to use good faith in terms of closing on an equity financing. So it could be a common round, you know, it could be, you know, for $100,000, or, you know, what, there's no minimum threshold. The only guiding principle is it has to be done in good faith, which, you know, can leave a lot to be desired.
And a somewhat related question, if you were silly enough to do a safe without a valuation cap and the company gets acquired, what happens to the money you invested in the safe?
You would, well, if there's no valuation cap, I'm not sure if it has a conversion ratio on an exit. I know you would have the opportunity to get your money back, and it would be paid back first before equity. But I don't know if there is, you know, some sort of concept of a conversion if there's no cap. I don't think that there is. So in that case, you basically just get your money back.
That would suck.
Yep.
Barry, would you get your money back?
Yeah, you always have the right to
Are you a
get your money
creditor,
back.
or what are you when you're holding one of these things?
Yeah, there's a lot of ambiguity around it. The safe says if you elect to get your cash paid back on an exit, you're treated more like a creditor than an equity holder. So you'd be paid back before the preferred stock in that situation.
So
That's
Gary,
what the instrument says.
so Gary, as an issuer, I understand why safes are attractive. I'm sure that if you and I spent a couple hours together, we could come up with something that's even more advantageous to the company, but we'd probably have to put a little bit of work into it, maybe a good bottle of wine. Why in God's name does anybody who cares about their money think that these are a good idea? And don't tell me that Y Combinator thinks it's good because they ain't playing with their own money and it's all magic money anyway. Why would a sane person do this? Dan was being very polite. Believe me, I'm holding back. Why would an investor think this is a good idea?
I don't know. I mean, it's always baffled me. You really get next to nothing. It's here, take my money, please, and then hope that something good happens, and wait for something to happen. It's really the equivalent of just trust us, which from a lawyer's perspective is that kind of runs against everything in our whole psyche.
But I guess if you're
People still
investing,
use them.
I guess if you're investing in a convertible note, it's sort of the same issue, isn't it? I mean, sure, you have the right to get some money back, but if the company's not doing well, there's no money to get back.
But that's true of preferred stock too.
Well, it's nice to be first in line with Dale. It's nice to be first in line with Dale.
This is Eric. There's one problem with convertible notes that safes do address. And we see this all the time. The convertible note matures, the company hasn't raised their qualified financing. And then what do? There is simply no good answer here. Almost invariably, you extend it. Maybe there's some negotiations, but you just extend it. You don't get paid back. Doesn't get called. And it's this funny situation where you're given these contractual rights that you're never going to exercise. So one good thing about the safe is it just avoids that situation, this artificial deadline, this artificial cliff, where when it happens, no one knows what to do anyway.
Yeah, I think that's the premise. But again, from an investor's perspective, you have significantly less recourse, and you're just basically waiting. I suppose as long as you have sort of the cap and the discount, and maybe an MFN provision, you have a bundle of rights then that you can say is somewhat reasonable. But Eric, I think you're right. The whole premise for the evolution of the safe was because the investment represented by the convertible note wasn't really intended to be a debt, but like you say, what happens at maturity if the company hasn't done, then the company never has the money to repay. So it puts you in a situation where you're using kind of a square peg in a round hole.
But Gary, if we go back to the origin of safes, they were never intended originally to be a substantial financing round. They were something that Y Combinator or someone in a position like that would use to help fund a promising company that they had intimate knowledge of and generally a fair amount of influence in. They were not supposed to be used to raise millions of dollars. They were meant to be very transitional capital for relatively small amounts to get the company going to the point where it could do something resembling a legitimate round.
Yeah, I think that's partially true. I think Y Combinator also has their own sort of deal with, that they use. So this was actually, I think, intended to be a little bit broader than just for what the Y Combinator capital was coming in, but definitely was intended to be transitory and relatively small amounts. I've actually seen some companies that have used safes, in excess of $10 million of funding on safes. So, that I think gets to be, on the far end of the extreme, but the spectrum. But I do think that they were thinking it would replace convertible notes, which is a broader financing than just the Y Combinator financing.
But convertible notes originally were used for exactly that. They were supposed to be a very short-term bridge financing to a round. And over the last 10 years or so, as the market has become more entrepreneur-friendly, entrepreneurs have decided to use them as a financing mechanism.
Yeah.
So why not safes if you're in an entrepreneur-friendly environment? Question for you, Gary. So if, with the way the market looks like it's shifting because of the pandemic, does it look like instruments like safes are going to go into decline as terms become more investor friendly?
I'm not sure. I think, as far as priced rounds go, I think the terms, you'll start to see more anti-dilution and maybe full action anti-dilution terms and MFN provisions. I don't think, though, that will necessarily impact the safe, just because the safe isn't, incorporating any terms yet. It's more or less just a placeholder. Yeah, so I don't know if the current situation is going to impact safes that much.
Is there a geographic distribution to safes? Do most of them happen in the valley? Do they happen throughout the rest of the country as well now? How does it work?
Yeah, that'd be an interesting question to see some data on. Angel Capital Association might be able to pull some of that. My sense is, probably 90% of the safes are done in Silicon Valley, and then the further away from there you get, it drops off. I think historically there had been a real reluctance on the East Coast, but we're starting to see some more happening in New York and Boston, and so it's definitely spreading. It's becoming more accepted, but I think it's not anywhere near the level of acceptance that it is down in Berkeley.
Do we have a question from somebody else, or should I continue to monopolize? Okay, Ron has a question. Unmute, Ron.
Yeah, I just wanted to ask, Gary, have you seen any sort of shenanigans around safes? Like, have you seen any weird stuff come up or seen weird outcomes as a result of someone who'd invested with the safe?
I've seen people go in and start modifying the safe terms, which, then, it's really kind of all bets are off, because, then you really have to sort of focus on, how these things work. And once you start modifying one term, it's kind of like a web. A lot of times they don't get done properly, and it kind of breaks some of the other things. So, it's a problem that I think if companies, start to go in and tinker with the terms, the better way to do that, and from an investor's standpoint, the better way to do it is through kind of side level work. If you want to get pro rata rights or something along those lines, you get it in a standalone document as opposed to someone modifying the agreement. But like I said at the outset, there's a paragraph, right? It's right after the first paragraph basically says, this safe is made between the company and the investor. And it says, this is intended to be one of the forms that's published at the Y Combinator website, and the company represents that it has made no changes to that form. And so if that paragraph is not in there, that's a big red flag for it.
Any other questions? Okay, Gary, then how about this? You talked a little bit about 1202. Do you really think that an investment in a safe before you actually invested in the round is going to be acceptable to the IRS for 1202?
I don't think so. Yeah, no, I would not take that position. Yeah, I think both 1202 and cap gains would only start once it's converted. There hasn't been, there certainly hasn't been any cases that I'm aware of or any guidance issued by the IRS. That's one of the other sort of, I guess, downsides of the safe. You have sort of less certainty. But, as long as you're not trying to be too aggressive, and I would say taking the position that your cap gains of 1202 holding period started when you invested in the safe, I'd say that is aggressive. I just, there's not a lot of guidance out there, and there's differences of opinion, but to me, it's, it's not worth taking that position. I don't think.
I see Drew has a question. You're next, Drew.
Hi, I just wanted to say thank you guys for the presentation. This is interesting. I've recently relocated back to Washington after 8 years in San Francisco, so I may have more of that Silicon Valley attitude where I sort of think of safes and convertible notes as almost interchangeable in terms of people just pick one or the other when they're doing something early stage. And I think when I look at this in the context, and I think this has been alluded to, sometimes this is just a cheap way to get the first money in. When I started a company and we had to raise that first 50 grand, and a lawyer quotes you $20,000 to do an equity financing with all the documentation, versus you can go and find a form like this and download it and just kind of be off to the races. Like, I think is the idea here that in some ways these things have been used far beyond what they would have ever been really designed for? And is there, if we look at it at that first money in, the first 6 to 12 months of a company, where it's just not worth everybody's time to worry too much about the minutia, it's more important to see whether or not this is actually going to be a viable thing that's worth additional diligence down the road, worth additional capital down the road. Is there still value for something like a safe or even a convertible note at that stage? Or even then, would you look for some other sort of financing vehicle?
Well, I think these things have sort of been used in a broader spectrum of financings than just sort of the right out of the gate company that's just been formed, trying to bring in a little bit of capital. And they usually, involve some negotiations, and, so I think the premise that, a company can just sort of download them and from the website and sign up an investor, I think it's true, but I think there's a lot of other situations where they're being used beyond that. It's, I guess, from the founder's standpoint, at least the ones that I interact with, and probably most of the people you're working with, they've already got lawyers, and it's not, to me, it's not any significant difference in putting together a convertible, a note, or a safe. It's, the note terms are all pretty standardized now. So I don't, from a cost savings perspective, it's kind of 6 of one, half dozen of the other, from my perspective. So I think you're right. The safe, for a company, just out of the box, if you want to bring in a, $100,000 or a couple $100,000, it's definitely an instrument you can use. And again, but that's with the premise that the company's going to be doing an equity financing round soon thereafter. That's really, I think, sort of the guiding principle is, how likely and how soon after raising the money in the safe are you going to be doing that priced equity round so that this thing converts. And that's where I think you see a lot of variability.
And that is indeed how we, excuse me, how I used it and how I've seen other people use it, where you sort of would alternate a convertible round with a priced round, which also got you some runway on a 409A and your ability to issue options advantageously to your people.
Yeah, that's a good point. And both the notes and the safes, they help preserve a lower valuation for 409A purposes. So, companies, issuing out their equity, their options under the equity incentive plan, they don't necessarily need to have a bump in their option price just because they've issued a safe or a convertible note. So that's one of the advantages of both a safe and a convertible note is you buy yourself some time to keep that employee equity price lower and more of an incentive for the employee.
Have you ever seen VCs come into safes?
Yeah, not that often, but I have.
And what happens if you follow a safe with a convertible note instead of a priced equity round?
It gets messy. Well, I mean, they both kind of coexist. I think, the safes, another time you see them being used is if it's a really hot company or it's a management team that's raised a lot of money and made people money in the past. And so people are basically willing to just give them their money so that they have a place in line for, the next price round. So it's kind of, where the issuer has, greater leverage, if you will, over the investor. But, to your point, Dan, you can have a safe and a note kind of coexist at the same time. There's nothing inherently a conflict there. The note holder is going to have some rights at maturity, but the safe holder won't. But they're both going to convert on their terms and price range.
Anybody else have a question before I ask my next one? I had the advantage of writing questions down in advance.
This is Frank Marshall. Thank you very much. I'm really enjoying this. Dan, it's really for you. Does AOA have a kind of a policy or an unwritten policy just to not do these?
Yes and no. I mean, look, what we've discovered over the years is our members like more investor-friendly deals. And so we would rather have a priced round than a convertible note, and we'd rather have a convertible note than a safe. However, having even said that, we've done common stock deals through the years, one of Gary's previous companies that I also invested in, Clarisonic, did common stock. And it was common because the founder put his own money in the deal to get the company going. And he said, I'm not taking in anybody else's money before getting paid out before mine. And people said, okay, and invested anyway. But look, all of us, is there anybody on the call who would rather have a safe than a priced round?
I like a guaranteed return, Dan. Just
Yeah.
line up for that.
If I could get that one, I'd sign up for it. But you know, the thing is, you sort of that's the answer to your question, Frank. We'd rather have price rounds, and we often tell entrepreneurs that if they're coming in with a convertible note raising $4 million and they don't need, and it's enough cash to last them 24 months, they're probably better off coming in with a priced round. And by the way, to the 409A, while I agree with what you said, if you are on the board of a company that's having a 409A done after a priced round, make sure that the evaluator understands the waterfall and the effect of the liquidation preference. I have succeeded on a couple of occasions of getting 409A valuations halved because the waterfall in the current valuation of the company indicated that the payout of common stock should be low. So next question.
All right, man.
Okay, well, I have a couple more, but I think I feel like I've monopolized the conversation here. Any final words of wisdom, Gary? If you were representing investors, would you tell them to do a safe?
No, definitely not. But, you know, would I say, you know, safe's a terrible instrument? No, I think it kind of gets back to, you know, what does the deal look like? You know, is it an investment management team that, you know, has done this before and you have some confidence in? You know, because that plays a part in terms of, you know, evaluating it. You know, how soon after, you know, raising this money are they going to do a price round? You know, you definitely have a lot less in terms of your, you know, bundle of rights with the safe. But, you know, the question is, and to Eric's point is, you know, are you really going to use them or not? The other sort of interesting component on convertible note is you've got this interest component that sort of adds, you know, the interest converts at the time that the principal converts. So in effect, it increases your discount, you know, because you get a little more conversion amount. But you also get some ordinary income that gets associated with that. So there's a little bit of tax complexity that gets associated with it. And then one of the other just things I point out on a convertible note, and I'm not sure how often this doesn't come up that often, but one thing that convertible notes often say is if the company gets acquired before there's a conversion, you get paid back some multiple of your investment, like 2x your principal amount or something. So that's another benefit to the convertible note that you don't see in the safe.
Although I guess an investor could negotiate that in, couldn't they, Gary?
You could, but then you start to, you know, get into that territory where you're sort of cracking open the terms of the safe. And, you know, it's no longer as simple as simply agreeing.
So I can offer a summary on this one. From an investor's perspective, there's nothing safe about a safe, which is a corollary to my other rule, which is that friends and family rounds are usually structured for people who really don't like either their friends or their family.
And angels aren't that nice.
You know what? Most angels are total pushovers and accept all kinds of abuse. And look, when we talk about convertible notes as an angel, I've been in one or two situations where we were really being abused, and I looked around to see if I could find enough other note holders to push back and say no. Now, that's where the majority conversion thing is a problem. I suspect in New York, it's easier to find other people who are willing to at least raise their hands when you say, are you abused, and willing to say no. In Seattle, it is usually tougher to get enough of my co-investors who are being screwed royally to let me do the work and just carry their votes than it is to negotiate a better deal out of the company. It's been my experience in almost every situation like that.
Yeah. Well, I'm in the same deal we bought a round and we're fighting the same issue.
I got to tell you, I don't know where everyone else, has had money fall out of the sky on them, but my family's worked really hard for what we have, and I really object when someone decides to take advantage of us. I don't understand why so many other angels, at least in the Northwest, are perfectly willing to take the abuse. But that's a subject of another webinar.
I had just written that down as a subject for a future webinar. Well, with that, please join me in thanking Gary for the wonderful, safes are something that are confusing to a lot of angels. And the clarity of what you said helped us truly understand the strengths and limitations of them, the reasons that people would do them and the reasons people wouldn't. It's really hard to find this kind of clarity on legal documents, but you succeeded once again. So thank you very much, Gary.
Well,
Yep.
thanks,
Thanks
Dan.
very
It
much.
was great to talk to everybody. And if you have any questions, feel free to reach out. I'm happy to talk to you and answer any questions you guys have.
Thanks, Gary.
Thanks a
Okay.
lot.
Yep. Bye-bye.
Thanks, Gary. Bye.